Yes.
Okay.
Now let's look at what Fast Graphs has here.
Right there.
And here's Fast Graph. Again, this is a tool that I have a subscription to, and if you're going to buy individual stocks, it's well worth the money. I think it costs like $500 a year.
Wasn't it a father and a son combo as well, Dad?
Yeah, the dad, he's called himself Mr. Valuation, a guy named Chuck Carnival. I think he's older than I am even, but he's been a value investor, and this is his technique. His son took his techniques and put it to a graphical form. And there's tons of data in this, and I'm not going to get in. I talked about it in depth with the Rexford video we did last month. But here's the SPY, the SP Standard & Poor's. So this goes back 20 years of performance, and the orange line that I'm looking at here, that's the 15% fair value ratio that Warren Buffett would buy it at. The blue line is where the market values it. Sometimes lower, sometimes higher. That's what it thinks it should be at. The black line is the price of the stock. So notice, if I'm looking at this is for 20 years, Warren Buffett would have bought it in 2008. That was the great financial crisis. And by the way, then the earnings went up. Here he could have got it for less than 15 times earnings. Here's 12 times earnings. This is a great time to buy it. And here it's right at the fair value. Then it started going up, and it was above the 15 for years. And then it dropped down to the 15 again, briefly, in 2018. Again in 2019 or 2020.
COVID, that's COVID. Right?
During COVID. Since then, it shot up, went down a little bit, and now it's in what I would call very frothy territory. It's up here, and it's like my chart indicated, the Excel spreadsheet. This is way over what the market is valued it at over history, and well over where Buffett would pay for it. Even with increasing earnings, which are these, it's expected to grow 15% this year, 14% in the next year, 10% the next year, which are very good growth rate. That gets it to here, but the price of the stock is already up here. So if it went from here to here, you're losing 20% of your money, or 9% annualized.
So, Dad, is this also, because we talked about it in episode 1, was emotion? You need to not be emotional, because when it makes sense to buy with logic and sound principles, that's when people are scared. And when it doesn't make sense to buy, everyone's thinking the market is never going to go down, and you should buy in, and stupid money takes over. Correct?
And that's the problem, because let's say in here, it was valued at 22 times earnings. It should have been 15. People look at this curve. Wow, they buy high because it's gone up, and then if it goes down, like from here to say here, you lost 21% of your money. If you bought here, sold it a year later, you lose 20%. People don't want to buy when it's going down, but that's when that's when it's a bargain. People didn't want to buy in here. The market's not doing anything. When it becomes popular, and by the way, for the Standard & Poor's, it's the underlying companies. So the NVIDIAs, the Microsofts, the Googles, people say they can't go down.